There is turmoil in the U.S. Treasury market after a major ruling from the Supreme Court on President Trump's tariffs. In a decision that struck down the president's tariff program, the court left one massive question there.
$778 billion in trade imbalance with Asia, more than $2 trillion in federal deficit spending in a single fiscal year, and hundreds of billions redirected out of the United States into alternative markets, while Canada records record capital inflows and leads major developed markets in equity performance. This is not a routine market rotation. It is the measurable face of a deepening trade war, reshaping North America's economic hierarchy. Today, we examine the widening divergence between the United States and Canada as global investors reassess risk, policy stability, and long-term growth credibility. Behind headline milestones in stock indexes lies a more complex financial reality: rising borrowing costs, weakening foreign participation in sovereign debt auctions, shifting supply chains, and an accelerating reallocation of trust. But beneath these headline figures lies a structural mechanism that few policymakers are openly discussing, a dynamic that could determine whether this divergence stabilizes or accelerates further. And before the end of this segment, we will uncover the deeper economic trigger driving this shift, a factor rarely acknowledged in public debate. The trade war is no longer operating at the level of tariffs alone. It has moved into the bloodstream of the financial system. What began as import taxes has evolved into a compound pressure cycle affecting sovereign debt markets, corporate financing, consumer credit, and global capital allocation. At the center of this acceleration is a brutal arithmetic reality. When tariffs are imposed at scale, they function as a domestic tax unless foreign exporters fully absorb the cost. Historical data from previous tariff cycles shows that the overwhelming majority of tariff burdens are passed through to domestic buyers. In a high inflation environment, that pass-through effect compounds. Higher import costs raise production input prices. Higher input prices squeeze margins. Compressed margins slow hiring. Slower hiring reduces income growth. Reduced income growth weakens consumption. That loop is not theoretical. It is mechanical. In the United States, elevated interest rates layered on top of tariff distortion have created a dual constraint environment. Treasury yields have remained structurally higher than pre-trade war averages. Mortgage rates have hovered near multi-decade highs. Corporate refinancing windows have narrowed. When debt costs rise across sovereign, corporate, and household balance sheets simultaneously, fragility spreads quietly. Meanwhile, the fiscal backdrop has deteriorated. The federal deficit has surpassed $2 trillion in a single fiscal year. Debt servicing costs are now competing with defense spending as one of the largest federal expenditure categories. When interest expense absorbs a growing share of federal revenue, policy flexibility shrinks. Markets understand this before voters do. Now contrast that with Canada. Canada entered the trade war as the presumed casualty. Instead, it leveraged diversification. Export composition has broadened. Energy contracts have locked in multi-year demand stability. Critical mineral agreements have strengthened long-term industrial positioning. Foreign direct investment flows have shifted north, not because Canada is immune to global volatility, but because investors perceive institutional continuity and lower policy shock probability. Capital is not patriotic. It is protective. There is another layer few are openly discussing. During extended trade wars, supply chains do not merely reroute temporarily, they redesign permanently. When multinational firms spend billions building alternative facilities, retraining labor forces, and securing non-United States supply agreements, those decisions are amortized over decades. They do not reverse because rhetoric softens. That is the hidden multiplier effect of this trade war. In financial markets, concentration risk inside major United States indices has intensified. A small cluster of mega capitalization firms continues to support headline performance. Outside that cluster, performance dispersion widens. When market breadth narrows while policy risk rises, institutional investors quietly hedge. In bond markets, Even modest reductions in foreign participation have outsized yield effects. A single percentage shift in global reserve allocation represents hundreds of billions of dollars. That scale influences borrowing costs for American homeowners, for small businesses, for municipalities. And here lies the acceleration trigger. As borrowing costs rise and fiscal deficits expand simultaneously, confidence becomes the decisive variable. If markets begin to demand a sustained risk premium for holding United States assets during an extended trade war, financing conditions tighten further. Tightening conditions slow growth. Slower growth worsens deficit ratios. Worsening ratios reinforce risk perception. This is how cycles compound. Canada, by contrast, has benefited from relative positioning, stable credit outlook, diversified export demand, strong commodity leverage during geopolitical realignment. These factors reduce the immediate need for aggressive fiscal expansion. That perception gap matters. The most underreported element in this acceleration phase is psychological. Global chief executives are increasingly factoring trade unpredictability into capital expenditure decisions. When quarterly earnings calls reference policy volatility as a primary risk variable, institutional behavior changes. Investment committees adjust geographic weightings. Sovereign wealth funds rebalance exposure. Trade wars are rarely won through declarations. They are decided by capital migration. And the uncomfortable question now confronting Washington is whether the current trajectory represents temporary turbulence or the early stage of structural repricing. Because if the repricing becomes entrenched, the consequences extend far beyond tariffs. In the next segment, we will examine the internal financial fractures emerging beneath the surface of headline market resilience, including a vulnerability that few public officials have acknowledged. That vulnerability may be the true inflection point in this trade war. The trade war has now moved beyond trade statistics and into the internal mechanics of the United States economy. What initially appeared as a strategic tariff policy has evolved into a layered financial strain. The effects are no longer confined to ports, customs declarations, or diplomatic statements. They are visible inside credit markets, regional banks, household balance sheets, and refinancing cycles. The United States entered this phase with historically elevated public debt and a higher interest rate environment. Sovereign debt has moved beyond $36 trillion, and annual interest payments have crossed $1 trillion. When debt servicing rivals major federal spending categories, flexibility narrows. In a prolonged trade war environment, that narrowing becomes strategically dangerous. Higher sovereign yields ripple outward. Mortgage rates remain elevated compared to pre-escalation averages, compressing housing affordability. Commercial real estate faces refinancing cliffs as loans issued during low rate periods mature into higher cost conditions. Regional financial institutions with concentrated exposure to property markets are forced to increase loss provisions, tightening lending standards. Credit tightening spreads incrementally. Small and medium-sized enterprises experience higher borrowing costs and shorter loan tenors. Expansion plans are postponed, hiring slows, and capital investment is deferred. The cycle does not collapse instantly, but it weakens from within. At the household level, the pressure compounds. Consumer debt in the United States has climbed above $18 trillion. Credit card delinquency rates have risen, auto loan defaults have increased, and household savings buffers have narrowed. When tariffs raise input prices for vehicles, appliances, electronics, and building materials, the cost of daily life absorbs the shock. This is the quiet multiplier of a trade war. Even when headline stock indices appear stable, median households feel margin compression. Higher financing costs combined with higher goods prices erode discretionary spending. Reduced discretionary spending feeds back into corporate revenue softness. The agricultural sector provides a stark example. Retaliatory tariffs reduce export competitiveness in global commodity markets. When overseas buyers diversify toward alternative suppliers, American producers require federal support programs to offset lost access. Subsidy support increases fiscal strain without restoring prior trade flows. Meanwhile, Canada has repositioned its agricultural exposure. Rather than relying primarily on the United States market, export diversification expanded toward Europe and the Indo-Pacific. Wheat, canola, and protein exports increasingly flow through multi-market agreements, distributing risk. That distribution reduces vulnerability to unilateral policy shifts. Energy markets deepen the divergence. Global energy insecurity has increased demand for stable suppliers. Canada's liquefied natural gas expansion and critical mineral development have attracted long-term infrastructure investment. Multi-year supply agreements reduce volatility exposure and anchor capital commitments. The United States retains enormous energy capacity, yet policy uncertainty surrounding infrastructure approvals and trade alignment introduces friction. Tariff-related input cost increases raise construction expenses for pipelines, refineries, and processing facilities. Delays erode momentum, and investors reallocate capital toward environments with fewer regulatory reversals. Bond markets reflect confidence gaps with precision. Even modest reductions in foreign central bank participation in United States Treasury markets influence yield structures. When global reserve managers rebalance a small percentage away from dollar assets, the absolute capital shift measures in the hundreds of billions. Yield sensitivity magnifies as deficits expand. Canada, by contrast, has maintained comparatively stable debt to gross domestic product metrics. International ratings agencies have sustained favorable outlook assessments. That stability narrows sovereign risk spreads and reduces borrowing cost volatility. In capital markets, perception of discipline translates directly into pricing advantage. Industrial production indicators further expose internal strain inside the United States. Capacity utilization has softened relative to pre-escalation levels. Input price volatility reduces predictability for machinery, equipment, and automotive manufacturers. Layoff announcements in tariff-sensitive sectors increase cautiously but steadily. Canada has capitalized on strategic sectors linked to global transition priorities. Lithium, cobalt, nickel, and rare earth development projects attract multinational partnerships seeking diversified supply chains. These projects are not speculative announcements. They involve long-duration extraction, processing, and export infrastructure. Once embedded, they anchor industrial ecosystems. Technology markets illustrate another layer of fragmentation. While leading United States technology firms remain globally dominant, international clients increasingly weigh data sovereignty and regulatory predictability. Canadian technology firms in artificial intelligence, governance, cybersecurity, and fintech have attracted growing venture capital allocations as neutral alternatives within North America. Capital migration rarely announces itself loudly. It appears first in incremental reweighting decisions, pension fund reallocations, and strategic joint ventures. Over time, those increments accumulate into structural change. The trade war has accelerated that accumulation. The psychological dimension now shapes executive planning. Corporate earnings calls increasingly cite policy unpredictability as a primary risk factor. When uncertainty enters forward guidance repeatedly, investment committees respond conservatively. Geographic diversification becomes standard practice rather than contingency planning. The United States remains one of the largest and most innovative economies in the world. However, scale alone does not immunize against erosion. When fiscal expansion, higher interest costs, and tariff distortion operate simultaneously, the margin for policy error narrows sharply. Canada's relative consolidation stems from adaptation rather than confrontation. Diversification reduced dependence, and stability lowered perceived risk premiums. Markets reward environments where contracts are expected to remain enforceable and policy trajectories appear consistent. The divergence is therefore not emotional. It is statistical and structural. Rising debt service, rising borrowing costs, rising consumer strain, and rising geopolitical hedging combine into a measurable internal fracture within the United States system. The most consequential phase of this trade war is not measured in quarterly earnings or monthly trade balances. It is measured in infrastructure commitments, multi-year contracts, and capital expenditures that lock in supply chain direction for decades. Once those commitments are made, reversal becomes economically irrational. That is where the United States now faces its most serious long-term test. Over the past several years, multinational corporations have redirected hundreds of billions of dollars in planned expansion away from concentrated exposure to the United States market and toward diversified corridors. Canada has captured a disproportionate share relative to its population and gross domestic product size. Advanced manufacturing clusters in Ontario and Quebec have expanded through battery assembly, semiconductor packaging partnerships, and critical mineral processing investments tied to global electric vehicle supply chains. These projects are not temporary hedges. They involve land acquisition, workforce training programs, logistics redesign, and regulatory alignment. When capital is deployed at that scale, it is amortized over 20 to 30-year horizons. Corporate boards do not reverse those allocations lightly. In the United States, reshoring ambitions encountered structural friction. Tariff-protected sectors saw elevated domestic input costs, particularly in steel and industrial materials. Downstream manufacturers absorbed higher production expenses, reducing competitive pricing flexibility. The intended boost to domestic manufacturing has been uneven, with gains in select industries offset by cost pressures in machinery, construction equipment, and automotive components. At the sovereign level, the fiscal dimension compounds the shift. Public debt exceeding $36 trillion and annual interest costs above $1 trillion constrain discretionary policy response. When deficits expand during a trade war rather than narrow, markets interpret the imbalance as structural rather than cyclical. Yield premiums become embedded into long-term borrowing assumptions. Foreign participation trends in United States debt markets remain a critical indicator. Even incremental percentage reallocations away from Treasury securities represent large capital flows at global reserve scale. As diversification strategies expand among central banks and sovereign wealth funds, the United States must offer higher yields to maintain demand equilibrium. Higher yields feed directly into consumer and corporate borrowing costs. Canada's comparative fiscal profile provides contrast. Debt to gross domestic product ratios remain more contained, and ratings outlook stability lowers sovereign spread volatility. International pension funds have increased exposure to Canadian infrastructure and energy transition assets, citing policy continuity and contractual reliability. Lower perceived risk premiums translate into sustained capital inflows. Energy geopolitics reinforces this alignment. European efforts to secure reliable liquefied natural gas and clean hydrogen supply have resulted in multi-decade agreements with Canadian producers. These agreements represent strategic integration into continental energy security planning. Long-duration contracts reduce price volatility and anchor infrastructure investment. The United States retains substantial energy output capacity, yet diplomatic unpredictability introduces negotiation friction. When trade relationships are framed as leverage tools, counterparties hedge accordingly. Hedging reduces exclusivity and encourages multipolar supply arrangements. Currency reserve composition offers another subtle signal. The United States dollar remains dominant, but incremental reserve diversification toward alternative currencies, including the Canadian dollar and the euro, indicates gradual hedging behavior. Even modest shifts reduce structural demand for United States sovereign assets over time. The deeper issue is reputational capital. For decades, the United States benefited from a reliability premium. Contracts governed under United States frameworks were assumed stable across political cycles. In a prolonged trade war environment characterized by abrupt tariff escalation and rhetorical confrontation, that premium is reassessed. Reassessment does not equal abandonment, but it does reduce automatic preference. Canada has positioned itself as a rule-based intermediary within a multipolar trade system. By strengthening multilateral engagement and expanding trade agreements beyond North America, it reduced single market dependency. Diversification has become structural doctrine rather than emergency adjustment. Inside the United States, economic polarization intensifies the impact. Large multinational firms with global revenue diversification absorb tariff turbulence more effectively. Smaller, domestically oriented firms experience disproportionate strain due to input cost increases and limited pricing power. This widening gap reshapes competitive dynamics within the domestic economy. Government stimulus measures designed to offset tariff fallout increase deficit pressure when not paired with structural revenue expansion. Over time, compounding fiscal commitments reduce strategic maneuverability. Markets incorporate that constraint into long-term pricing. The defining risk for the United States is permanence. Once supply chains are rebuilt, supplier relationships renegotiated, and capital amortization schedules locked in, the gravitational pull of the American market weakens incrementally. Trade corridors that expand around the United States during a trade war can solidify into durable alternatives. Canada's ascent is not the result of confrontation. It is the byproduct of adaptive positioning within global realignment. By offering continuity and leveraging resource advantages, it attracted capital-seeking insulation from volatility. That perception gap between stability and unpredictability drives investment decisions more powerfully than rhetoric. This moment, therefore, represents more than cyclical underperformance. It reflects a redistribution of trust within the global economic system. Trust influences borrowing costs, foreign direct investment, alliance cohesion, and long-term industrial planning. When trust migrates, capital follows. The United States remains deeply influential, technologically advanced, and economically large. However, size does not negate risk premiums. If the trade war environment persists without policy recalibration, risk pricing may harden into structural discount. The critical question is whether strategic correction occurs before diversification becomes irreversible. Because once capital geography changes at infrastructure scale, the window for easy reversal closes. In the final segment, we will confront the decisive question: is this trajectory a temporary distortion within the United States growth cycle, or the beginning of a long-term redistribution of economic gravity in North America that few policymakers have fully acknowledged? $778 billion in trade imbalance with Asia. More than $2 trillion in annual federal deficit spending. Sovereign debt exceeding $36 trillion. Interest payments surpassing $1 trillion per year. These are not abstract macroeconomic figures. They are the structural backdrop of a prolonged trade war that is reshaping the competitive balance between the United States and Canada. Over the course of this analysis, we have traced the divergence across multiple dimensions: equity market breadth, foreign direct investment flows, sovereign bond demand, supply chain reconfiguration, industrial policy execution, and household level pressure. In each category, markets are pricing higher uncertainty into United States assets while assigning lower volatility premiums to Canada. The trade war was framed as a tool to restore leverage and reduce dependency. Yet deficits have expanded rather than narrowed. Borrowing costs have risen rather than stabilized, and global partners have diversified rather than consolidated around Washington. Meanwhile, Canada has leveraged energy security, critical mineral supply, multilateral trade frameworks, and institutional continuity to attract capital-seeking predictability within North America. This does not mean the United States is collapsing. It remains one of the largest and most innovative economies in the world. However, erosion does not require collapse. It requires sustained risk repricing, incremental capital migration, and embedded supply chain redesign. Those forces are measurable, and they compound over time. The decisive variable now is duration. If trade war dynamics persist without recalibration, the structural shift toward diversification away from the United States may harden into permanence. If policy stability returns and risk premiums decline, some capital could flow back. But history shows that once supply chains and long-term contracts realign, reversal becomes slow and expensive. So the central question remains: is this a bold strategic reset for the United States, or a costly miscalculation accelerating Canada's rise within a multipolar trade system? The answer will not be delivered through political speeches or symbolic market milestones. It will be written in bond yields, trade balances, investment commitments, and household balance sheets. Thanks for watching.